Hey, it's Patrick with Ironclad Wealth Management here, and today we've got the kickoff to a multi-part series on how to save taxes on the sale of your business. And really, this intro video is going to go over the basics and then go over kind of how we think about saving money on taxes when you're getting ready to sell the business, plus a quick intro to the strategies that we're going to cover in our later videos in this series. So, with that being said, real quick, we do have some disclosures because obviously we're talking about general tax information, but it's exactly that, it's general. So, if you have any questions, concerns, any questions about your specific business, you need to speak to your own tax advisor, whether you decide to reach out to us or you decide to reach out to your existing financial planner or CPA. So the first thing to kind of do is put what the sale of a business is in context. And to understand that, first you need to understand that selling a business is more than just a financial transaction. It's a personal, emotional transaction, something that you have been working on for probably the majority of your life. In some cases, maybe it's been 5 years. That's still a long time. But because of that, there's three main key areas of a business sale, and we'll explore all of these at some point in the future. The first is the business side. Is the business ready to be sold? That is step number one. The second side is the emotional side. Are you ready to sell? When that business isn't there for you, what are you going to do? Do you have that plan in place? And then the third side, where taxes come in, is the financial side. You know what you want to do in option number two. So for step three, will you have enough to live on after the sale? And that's where taxes come in. Because if taxes take a big chunk out of that, are you really going to get what you expected on the front end when you started the sales process? So, as far as the ultimate guide to selling a business series goes, we've got kind of the overview, which is what we're talking about here. We're going to do an asset versus stock sale breakdown next. And then we've got seven specific strategy breakdowns going over the pros, cons, kind of how some general strategies work. So you can kind of read through them, watch them, and decide if they make sense for you. So let's kind of get going. So, as I mentioned earlier, why taxes matter is fairly straightforward. At the end of the day, they reduce what you can put in your pocket. And that's what you're going to be able to live on when you do stop working and you sell your business. And if you don't do any tax planning on the front end, you might wind up losing 30, 20, 30, or even more of your proceeds in taxes. So if you think about just the capital gains rate, 20% is at the top level, plus the Obamacare net investment income tax surcharge, plus your state taxes. All of a sudden, you're climbing towards 30%. And then if you have some ordinary income components to your sale, you might hit that 40% rate. So you need to know these numbers. And why it's so important is this is a different tax system than the taxes that you were paying while you were working. There's different things to know, different things that are important. It's not as simple as how much money is coming in the door and how much money is going out. There is more to selling a business and the taxes on said sale than just those two items. So you need to have a plan before you make that sale. Now, what you need to know first is what is your wealth gap? And what a wealth gap is it's the difference between what you got in your pocket today and how much you need to live on when you reach retirement. So if you think about it in numbers terms, it's what you need each year. So in this example, I'm saying $250,000 divided by what your withdrawal rate is, your safe withdrawal rate. Let's say it's 4%. That's just kind of the industry standard. If you needed $250,000 a year at 4%, you would need about $6.25 million to live the rest of your life really without worrying. If you had $2 million in your outside investment accounts, that's the personal investments tab here, that would mean that your wealth gap is $4.25 million. So when you're going out to market trying to think of what do I need to do to make this a reality, you need to try and sell your business for $4.25 million. However, that's a pre-tax number. If you have a 25% tax rate, all of a sudden it means that you need to sell that $4.25 million business for $5.67 million. So that is where tax planning comes into the kind of the equation. What are you going to do to drive that down from $5.67 million to $4.25 million? So, a quick overview of what you can do is we've got about seven strategies that we've identified, and this is going to be just a real quick overview that goes over the strategies because each one has pros, cons, and things you need to know and avoid when you're doing them because they don't all work for everyone. So, the first strategy is the easiest. and that is the installment sale. It's all about timing, timing, timing. Because all you're doing is you're taking the $10 million you made, and instead of putting it all in 1 year, you're doing $1 million each year for the next 10 years. And if you agree to that as part of the sales, you will pay a significantly lower amount in taxes. However, what happens when you do this is the risk that you are carrying is that you don't get paid. So, usually, most sellers don't want to use this strategy because if the buyer can't make the payments, they're SOL. So, if you look at this, this is something that's typically done with employees, typically done with family members, or maybe a portion of a sale might wind up being an installment sale. But simply by utilizing time, an installment sale is an effective tax planning strategy. It just has some major drawbacks. Now, there is a solution that solves the major drawback to installment sales, and it's called a structured installment sale. Now, what it is it's very simple, and I know this diagram may get a little confusing, but think of it this way. Your buyer has the cash. Instead of giving the cash to you, they give it to a third party who then guarantees that they will make the installment payments to you as the seller. So you get to spread your taxes over multiple years, and you don't have to worry about the buyer going bankrupt or not being able to sell, or sorry, continue to make the payments that you've got as part of the sales agreement. Now, that brings us to the next question is okay, well, now I just have a risk that the intermediary goes out of business. And that's true, but typically these intermediaries are highly rated insurance companies. So it's something that I would much rather have my money with a highly rated insurance company than with my old former, let's say, CFO or, general manager who's buying me out. So it's something that definitely works. And like I said earlier, I'm doing an in-depth video on each one of these strategies. So if that's interesting, take a look. Now, the next strategy that's out there is called the QSBS exclusion, the Qualified Small Business Stock Exclusion. Now, this is a really cool one because it excludes up to $15 million or 10 times your investment from capital gains, meaning if you put $2 million into the business, you can get up to $20 million back tax-free. This one has some fairly restrictive requirements on it. It has to be a C Corp, has to be original stock. You can't have bought it from someone else. There has to be less than $75 million in assets, and then 80% of those assets have to be used in what's called a qualified business. That's the Q and QSBS. Those are things like financial planners are not qualified, doctors, things where you have to rely on skills of the owners. Those typically don't qualify. But like I said, we'll have a detailed breakdown in the video about QSBS after this. Now, this is best for C Corp owners who have a 5-year holding period that's required to get this treatment, although it does start to phase in at 3 years now, and companies with a lower net income but a higher expected exit multiple. So if that sounds like you, QSBS might be worth looking into. Check out our more in-depth video. Now, the next strategy is called a charitable remainder trust. Basically, what this does is it lets you have the best of both worlds. It lets you pay not too much in taxes, and it lets you leave a little bit of money to the charity that matters most to you. What you do, you take your stock, you donate to your charitable trust before the sale. The charity then sells said stock, and they don't pay taxes because it's a charitable trust. Then while you live, you can take payments each year from that trust, and when you pass away, whatever's left in that account goes to the charity that you named. So it's a very interesting solution if you do have some charitable concerns or funds or endowments that you care about. But it is something that I'm not sure makes 100% sense if you don't. So if you are charitably inclined, and you've got some time before the sale, it could be worth looking into. Now, the next strategy, real quick, is opportunity zone. So a qualified opportunity zone fund is something that if you invest within 180 days, you can't eliminate taxes, but you can defer them. So you defer taxes. If you sell it before the end of 2026, you can only defer till the end of 2026. And if you sell after 2026, beginning in 2027, you can defer your taxes for 5 years. Now, once again, with everything else, there are some restrictions in here, but this is a really interesting strategy that was just made permanent as part of the OBBBA. So it could be worth looking into, especially if you can afford to really not touch that money for 10 years, which is really where you get the biggest tax benefits. So those are the 7 strategies I wanted to give you a quick overview on. And like I said, we'll have detailed information for each one coming in future videos. So take a look at your YouTube guide and see if you can click through to those other videos. But to wrap it up, what do you need to know to prepare for taxes on the sale of your business? First things first, you need to have knowledge. You need to know what your wealth gap is. That will inform you as far as things like negotiations in the business, what type of sale you're going to make, what you need to do on the personal side to minimize those taxes and put as much money in your pocket as possible. You need to know that first. Once you know the wealth gap, you can decide on which strategy works best for you. And then you can kind of look at your personal side. Okay, hey, what do I need to do to make this work? Can I live with those trade offs? Because most strategies, spoiler alert, have trade offs. And then finally, once you decide that, or probably before you decide that, when you start looking at it, you need to work with a qualified team who can help you review those decisions. So, as I've said throughout this, we've got detailed blogs and videos on each of the strategies. If any of them piqued your interest, go take a look at those. And if instead you do have a business coming up and you're not sure which one works for you, schedule a consultation. Please do it with plenty of time before you're contemplating selling the business, and you can follow this link to check things out. So I hope you all have a good rest of the day, and I hope you found this interesting.